Okay, we're live now. Hey, Vaibhav, I'm keeping myself on mute.
Yeah.
I'm still, can you hear me?
Yeah, I can hear you.
I'm
Yeah.
still driving, so I'm keeping myself on mute. I'll
Okay.
participate in time.
You are still driving.
Yes.
Okay. All right. No issues. No, no issues. No, then Sunay is there. Sunay is there. No issues. All right. All right. Thanks. Yeah.
Perfect, perfect.
Mhm. I think everyone's audio and video are off, Jijo. I think then we can begin.
Yes.
All right. So cool. It's already time. I think around 40 people have joined the chat, and we are already live, right?
Yes, we're live.
Yeah. Okay. All right. Thanks. So, good morning, good afternoon, good evening, everyone, from your respective countries, time zones you have joined. And this is the 10th session of the Entrepreneurship GAN. Some of you, as I can see, have been kind of consistent participants. You may already know about the Entrepreneurship GAN. For those of you who are new, we started this initiative with by Praveen Mallaji, which I took over last year and I started leading it. We came up with this particular initiative known as the Entrepreneurship GAN, and the idea is to have this global platform where people can connect and talk about entrepreneurship, and we can invite people from the entrepreneurial world, but also people from the industry, people from academia, and build this collaborative platform where entrepreneurs can reach out to mentors for any help that they may need. But apart from any entrepreneur, we are especially focused on young entrepreneurs because a lot of them are not very well aware, whom to reach out to and where to build that initial connections. And that's the idea that the entrepreneurship GAN, we had in mind. So when we started last year in June, we invited Raman Ramanathan ji, for example, for the inaugural lecture, which was done by the Hyderabad chapter. Since then, we have been having all the TEG events, which were just hosted by TEG. And now this is like the 10th event. And now again, we are having this particular event with the Pune chapter. And we have Anil Lamma-ji, who's also from Pune, which is very interesting to have someone who is from the Pune ecosystem itself for this particular talk. And then, as I have mentioned it previously as well, we are coming up with a mentors platform as well, in which you'll have a website where you can go and connect with mentors, reach out to them, stuff like that. But also, we are also planning for a larger event. Possibly it will be hybrid or it will be in-person event. I'm not very sure. We are still deciding on that. Sometime later this event, that's the whole plan. But then the idea of TEG is to build this collaborative platform, as I mentioned. So we have an active WhatsApp group. Some of you may have already joined. In case if you haven't joined, maybe feel free to join that as well. And if you are an IT Bombay alumni, there is a special interest group on Telegram, which you can always join and just let me know. So I'll ask my colleague Sunay to formally introduce the speaker, and then we can move ahead from that. To you, Sunay.
Right. Hello. Our speaker today is Mr. Anil Lamba, a best-selling author, financial literacy activist, and an international corporate trainer. Dr. Anil Lamba is a practicing chartered accountant and holds degrees in commerce law and a doctorate in taxation. Dr. Lamba's training programs are held internationally with a client list exceeding 3,000 large and medium-sized corporations. spread across several countries, including India, US, and in Europe, Russia, Africa, the Middle East, and the Far East. He has conceptualized and is actively engaged in the implementation of Financially Intelligent Organization, a certification awarded by LAMCON to corporations for management accounting processes and financial acumen, and financial literacy for all, a movement towards creating a financially intelligent India. This is a social responsibility project with the aim of spreading financial literacy among 1 billion Indians. With over 2 decades of experience in training and consulting in finance, Dr. Anil Lamba has created and developed 2 series of training videos: Figure Out the World of Figures and Anil Lamba on Finance, and has done pioneering work in distance education and e-learning. He has also written several books and over 1,500 articles. His books, Romancing the Balance Sheet, Flirting with Stocks, Eye on the Bottom Line, and Financial Affairs of the Common Man, are currently making waves. So that's about our speaker, and I hand it over to him.
Thanks a lot, Sona. So, Anilji, maybe you can just go ahead and share your screen. Yeah, we can see your presentation.
Sure.
Yeah.
Hey, good evening, everybody. A pleasure to be talking to you today. Actually, Weber, it may not have been a bad idea if some people's videos you had enabled. Then it would feel like a live classroom. You can disable the audio.
That has created trouble in the path. So that's why we usually keep the video on off. Yeah. Mm-hmm.
Is it okay? To a speaker,
Yeah,
talking to
because
a
it
blank
is
screen is not very.
Yeah, because it's not only ITB alumni; it's open to all. So sometimes there are some youngsters, some students from some colleges, which at times create nuisance as well. So that's why we
Maybe a
decided
few
to keep
people,
it.
yeah. I think the few of you can be on because it feel
Yeah.
like feel like you're talking to some.
All
So
right. Yeah. Yeah.
any case,
Please
good.
continue.
Yeah. So once again, folks, the time, of course, allotted is too short. Normally, when somebody says, we'll do a 1 full day program on finance, my reaction is that's too short. What will I tell you? Just about in 1 day, we should be talking at least for 3 to 5 days. So I've been told to speak for 40 minutes. So I'm going to be super fast so that I can cover some ground in those 40 minutes and leave you with something of value. Let me start by asking you a question. If I ask you to describe what is the business of this company, now I'll tell you what business they are not in. This company is not in the business of manufacturing automobiles. Tell me what business is this company not in? They are not in the business of making software. This company is not in the business of providing hospitality. You guys, you are not in the business in which you think you are, farming or whatever it could be. All these companies are in the same business. And folks, never to forget, the business of running a business enterprise is to make profit. Their methods are different. Tata Motor does it through making automobiles, and Hilton does it through providing hospitality. But the single objective of running a business is to make profit. Second question before I proceed, how many of you right now attending this session, tell me how, and guys, if you're in the business of profit, please remember the profit is not in the product. Most people spend days and weeks and months thinking, which line should I get into? Because they think profit is in the product. But if profit was in the product, then two people making the same product, same size, same everything, should be making the same profit. That will never happen. Pick up to car manufacturers, pick up to airlines, pick up to builders. That will never happen because profit it depends on your finance management. Second question before I proceed, how many of you attending this right now are non-finance people? Can I see something at least in the chat box? If you think you're non-finance, thank you for raising your hand. Others can say, if you say you're non-finance, say me. Yeah, right, like Jayesh has said. And if you think you're finance person, say not me. How many of you are non-finance people, guys? These messages are coming as direct messages to me. I don't know why. So I don't know whether the rest of you can see or not. But lots of people are saying me, me, me. Guys, once again, the answer is absolutely wrong. When I ask you how many of you are non-finance people, not a single hand should have gone up. No, your hand should not have gone up. Now that raises an interesting question. You are saying you are non-finance. I am saying you should not say so. The problem seems to be in the definition. How you are defining who a finance person is and how I seem to be defining. Guys, none of you are non-finance people. What do I mean by that? Tell me, who is a finance person? What is the job of a finance person? Is it the job of a finance person to track financial information, to collect financial data, to record that information, to collate that information, to prepare financial statements like profit loss accounts and balance sheets? Is that the job of the finance person? Answer is no. That is the job of the accounts person. So had my question been, Rachit, how many of you are non-accounting professionals? Then if your hands had gone up, I would have agreed with you. But folks, if collecting, recording, presenting financial information is not finance management, then what is finance management? I'm going to give you my definition now. Folks, according to me, finance management is the ability on the part of every individual to understand the financial implication of your actions. And what do I mean by the financial implication? How your action will impact the company's bottom line. Doesn't matter whether you're in charge of sales, doesn't matter if you're in charge of production, you're in charge of HR, you're in charge of purchases. Every action of yours is having an impact on the bottom line, which is either a positive impact or a negative impact. And the ability to gauge that, according to me, is what finance management is. And why should everybody understand how their actions will impact the bottom line? So that as far as possible, every individual only does those things by which the bottom line becomes stronger and avoids doing things that hurt the bottom line. And folks, if this is what finance management is, then I think every individual whose actions have the power to affect the bottom line is a finance person. Had I asked all of you once again, how many of your actions affect your company's bottom line, this time I'm sure all hands would have gone up. Then when people like you say I'm a non-finance person, I kind of interpret that answer to be, you are saying, I don't care how my action will affect my company's bottom line. That's ridiculous. You should be doing nothing without first ensuring, are you strengthening that number or are you hurting that number? Guys, do everything that strengthens it. Do nothing that hurts it. Let's take a simple example. Let's say there's a salesperson out in the field. This guy is selling whatever, tables. This salesperson bumps into a potential customer. Customer asks him, how much is your table for? For argument's sake, let's say he says 10,000 rupees. That customer says, I am starting a new educational institution. I need 1,000 such tables. But my budget is not 10,000. I cannot go beyond, put any number, 8,000. What offer is received by the salesperson? The customer is saying, if you are willing to give me this table for 8,000 rupees, I'll be happy to place an order of 1,000 tables. Tell me, such offers must be coming the way of salespeople all the while. Standing in the field, this person is expected to say yes or no to this offer. The moment he says yes or no, has he taken a sales decision or has he taken a financial decision? Guys, he will call it a sales decision, but I'm saying this is finance management in action. You understand, if this sales fellow's company could afford 8,000, this person has just now committed a crime against the company if he said no to the customer. And if his company could not afford 8,000, he would have committed a bigger crime against the company if he said yes to the customer. Now, do you see anybody from the finance department in the picture when the decision is being taken? And I can give you similar examples from virtually every function within the company. I'm saying every purchase decision, every HR decision, every production decision has a financial implication. When do organizations make a profit? Folks, you will appreciate 24/7, whatever every individual is doing, that fellow's actions are either adding to the bottom line or taking away from it. When a larger percentage of people take decisions by which the bottom line becomes stronger and a smaller percentage are hurting it, end result is profit, vice versa, it's a loss. After everything is over, people like me, the finance people, will come into the picture. They'll do a post-mortem and tell you whether you made a profit or not. What I'm trying to tell you, folks, is people like you who say they are non-finance are the ones whose actions generate profit for the company. People like me who are finance professionals, our actions calculate profit for the company. Tell me, who's the real finance person? The people whose actions generate profit or the ones whose actions calculate profit? How many of you are non-finance people? I can't see you, so I assume this time no hand should have gone up. I hope so. But I do understand when you say you're non-finance, you are actually expressing your knowledge gaps. Maybe this is not a subject you studied while during your education, etc., etc. That is the lacuna we must plug. Of course, today is too short a session to make a dent, but I'm going to try and leave you with some thoughts. I want to introduce you to this most fascinating statement called a balance sheet. Let's imagine, I can see only two people here, Vaibhav and Rachit. So let's say Rachit over here starts a new business. Rachit, shall we do that? Okay. I don't know what line of business you are in, but let's take a simple business. Rachit starts a furniture manufacturing organization. And let's say he calls it Rachit Furnitures, RF. Now, guys, Rachit Furnitures needs money to begin with. Where will it get money from? The first person it will go to is Mr. Rachit. Rachit, give me some money. Rachit will say, how much do you want? Let's put reasonably large numbers. RF says, I need 1,000 crores. And let's say Rachit says, I'm not interested in giving you 1,000 crores, but I don't mind giving you 400 crores. What is this 400 crores called? It will be called, if it's a proprietary concern, it will be Rachit's capital. If the amount is large, there could be several of them, then they are called shareholders, and the capital contributed would be called share capital. But the company required 1,000. So for the remaining 600, they go to a bank or somebody and take a loan. Guys, balance sheet has two sides, liabilities and assets. Liabilities simply tell you where the money came from. And assets tell you what you did with the money. So when RF wanted money, where did the money come from? In this case, 400 crores has come from the owners, 600 crores has come from the outsiders. But since we consider Rachit as different from Rachit Furnitures has borrowed money from Rachit. And it has borrowed money from a banker. Since both are in the nature of borrowings, both appear as liabilities. But tell me, what is the difference between Mr. Rachit as a lender and the banker as a lender? Answer is the difference lies in the terms of lending. On what term did Rachit lend? On what term did the banker lend? You will all appreciate when somebody goes to borrow, no lender is ever going to lend you money without asking several questions, due diligence kind of questions. What kind of questions would a lender want to know before giving you the money? Questions designed to understand the need for money, the ability to intelligently deploy the money, the ability to generate revenue, the ability to service the loan, and the ability to return the loan. Guys, pardon the speed. I'm only going fast so that I can do something meaningful in the limited 40 minutes given to me. So when RF wanted money and it went to Rachit and it went to the bank, both these people must have asked these questions. What answer they must have received? RF must have said, gentlemen, I'm asking for money because I intend setting up a furniture manufacturing organization. So Mr. Rachit, Mr. Banker, I'm going to take your money and then I will use it to spend that money and buy some fantastic assets for myself. Then I will use your money to buy raw materials. I will use your money to hire people. And once my product is ready, I will use your money to do sales and marketing. And then when I have sold my product, I'm going to make profit. And when I make profit, Mr. Rachit, I'm going to reward you. Mr. Banker, I'm going to reward you also. And both these people must have said, RF, we have no doubt at all. When you earn, of course, you will reward us. But our worry is something else. Our worry is you think you're going to make profits. Can you tell us what will happen in case you don't make profits? And if RF must have said, guys, if I make profit, I will reward you. If I don't make profit, how can I reward you? Listening to this kind of an answer, out of these two lenders, one of them will chicken out. One of them will back out. Who will back out, guys? Obviously, the banker. The banker is going to say, if my rewards are going to depend upon whether you earn or you don't earn, then I'm sorry, I'm not interested in lending. I will lend you on one condition. What is the condition? Guarantee me a reward. And RF must have said, banker, that's pretty unfair. If I don't earn, how can I guarantee you a reward? But we all know there are times in life where beggars can't be choosers. You want the banker's money, you'll have to agree to the banker's conditions also. So reluctantly, RF must have said, all right, Mr. Banker, you expect us to continue giving you a reward even when we are losing money? Okay, I'm going to agree to that because I have no choice. I need your money badly. But then RF must have said, Mr. Banker, then even I have a couple of requests. Request number one, you expect me to continue giving you a reward even if I'm making losses? Then first of all, Mr. Banker, don't keep your expectations sky high. You want a reasonable kind of a return. Maybe I'll be able to afford it even when I'm losing. Banker must have said, I'm happy with 10%. Do you see the 10% next to the loan? And RF must have said, Mr. Banker, request number two. You want me to give you 10% when I'm losing? I'm agreeing. But on the other hand, don't forget, I might earn. And I could earn a huge amount of profit also. Then you, Mr. Banker, don't keep an eye on that. If I'm going to give you 10% when I'm losing, I will give you the same 10% when I make pots of money. Banker must have said, fair enough. I'd rather have the assurance of a guaranteed return than have the possibility of a very high return in 1 year and nothing in another year. Guys, point I'm trying to make is, on what terms do bankers and outsiders lend? They lend on the condition, give us a guaranteed but a limited amount of return. Now, to this conversation going on between RF and bank, Rachit is listening to. Rachit now turns around and says, RF, I am not like the bank. I am not so unreasonable. I understand you will have ups and downs in your life. Some years you'll make profits, some years you may not make profits. Rachit says, RF, I am willing to give you my money with no guarantees whatsoever. What does that mean? He says, RF, if you don't make profit, I'm okay if you give me nothing. But he says, you understand, I'm taking a risk. I might get nothing. So Rachit says, RF, if you don't make profit, I will take nothing. But to compensate for that risk, when you do make profit, and after everybody's been paid off, then I will take everything. Is that also fair, guys? On what terms do bankers and outsiders lend? They lend on the condition, give us a guaranteed but a limited amount of return. Owners lend on the condition, don't want guarantees, but then don't want limits on how much we can earn either. This company takes 400 crores from the owners, 600 crores from outsiders. The 1,000 crores get deployed on the right-hand side. Wonderful assets are purchased by this company. The assets are put into use. And now this company starts generating revenue. Guys, imagine on deployment of 1,000 crores, this company has now generated a sales revenue of 3,000 crores. So far, nobody has been paid. I want all of you to visualize and tell me how many groups of claimants can you visualize standing in a line saying, we want a share of the 3,000 crores. How will the 3,000 crores of revenue be distributed? This company hasn't paid salaries to employees yet. They haven't paid raw material suppliers. They haven't paid rent to the landlord. They haven't paid the printer, the stationer, the telephone, the water, the airline, the travel agent, etc., etc. But these are items. I want groups. Can I say all these items, Jayesh, all these items put together comprise one group called operating expenses. So one group standing in a line, operating expenses, wonderful, Sudarshan. Second group standing in a line will be shareholders. Sudarshan has mentioned all of the guys. Third group standing in the line will be the lenders. And fourth group, of course, our partner in whatever we do is the government. For income, guys, when I say government, I mean income tax, not GST. GST is part of operating expenses. Folks, doesn't matter where you are, doesn't matter what line of business you may be in, whatever sales revenue your organization will generate will get distributed between these four groups, but not in this order. Let us now decide the order. Whose claim will RF entertain first? Guys, keep giving answers in chat box so some kind of conversation is going on between us to get a feel of a real life classroom. That's all. Guys, first claim to be entertained will be of operating expense. No, not lenders, Vishnu, yet. Operating. Correct, Kunal. Operating expenses. First of the month comes, salary has to be paid. On the due date, rent has to be paid. Overheads have to be paid. Imagine this company's operating expenses can't happen to be 1,600 crores. How much did that leave you with? 1,400. What is this 1,400 called? What is this 1,400 called, guys? Okay, this is either called, in case you're saying gross profit. Yeah, I was about to say, Sudarshan, this is not gross. No, guys, hold it. Yeah, Kunal, Kamal is right. Guys, this is not gross profit. To arrive at gross profit, I'll have to split that 1,600 into two parts. When I minus the first part, it's gross profit. When I minus the second part, it will either be called operating profit, as Srikanth also says, or what kind of profit is this? This is that stage of profit where from sales, you have recovered the operating expenses, but you still have not paid dividend to the shareholder. You still have not paid interest to the Srikanth, remove that da from there. You haven't paid interest to the lender. You haven't paid income tax to the government. So this is also called profit before interest and tax or earnings before interest and tax. DA stands for depreciation and amortization, Srikanth, which I assume is part of operating expenses. That's already minused. Now, how many groups are left, folks? 3. Whose turn now? Now you pay the... I'd love to wait for answers, but that will consume time. I'm short of time. No, Kanal and Jayesh and Srikanth, not the government yet. Country needs more people like you guys, but don't be in a hurry to pay the government. Now we pay the lenders. How much has this company borrowed? Correct, Priyesh. 600 crores. At what rate? 10%. So you pay the bankers 60. That leaves you with 1340. What is this figure called? From PBIT, I has been paid. Interest has been paid. So that gives you PBT. Now 2 groups are left. Now who do we pay? No, Srikanth, government won't come after you. It's not due to them yet. Correct. Now we pay the government. Imagine your income tax works out to 340. That leaves you with 1,000. What is this figure called? This is now called profit after tax, PAT. Who does this belong to? This belongs to the owners. Our owner happens to be Rachit. So now in the line, Rachit is standing there. He will say, RF, I had told you, if you don't earn, I will take nothing. But on the other hand, when you do earn and after everybody's been paid off, I will take everything. So Rachit will say, RF, this 1,000 crores, please give it to me. But folks, when RF wanted Rachit's money, it had gone and made all kinds of rash promises to him. Yes, Rachit, all the profit will be given to you and this and that. But now that it's time to actually give it to him, this company starts having a change of heart. They start negotiating with Rachit. They say, Rachit, we said all the profit belongs to you. And of course, it does belong to you. Rachit, you are the owner of the company. But they say, Mr. Rachit, how much money did you give us? Your contribution is 400 crores. They say, Rachit, had you not, correct, Rachit is only answering, okay. They said, had you not given this 400 to us, had you instead kept it in a bank, how much would you have earned? 5%? Fixed deposit, 7%? Bonds, etc., 8, 9, 10%. Risky ventures, 15, 18, 20%. They say, Rachit, we can give you 30%. or maybe 40%. On the outside, we can stretch up to 50%. But Rachit, don't take the 1,000 crores away. Why are they saying this? Are they trying to cheat him? Answer is no. Ultimately, he's the owner. Then why are they not giving it to him? Have you noticed, guys? No company gives entire profit to shareholders. My question is, why not? The shareholders' condition of joining was that if you don't earn, I will take nothing. Folks, you will appreciate, had this company not earned, this part of the bargain they would have honored completely. The second part of the bargain was, guys, I may not be able to read all your comments that become simultaneous since I'm speaking continuously. So pardon me if I don't answer some of your questions. A second part of the condition was that when you do earn, I will take everything. Having promised to him, why are they not giving it to him? So whenever I ask this question, I get numerous answers. If there's a live audience like you, but who can talk back to me, that, this company wants to keep some profit for future, for growth, for expansion. After pandemic, we realized things like this can also happen, and even the loan has yet to be returned, etc., etc., etc. And my reaction always is, I will accept all your answers, but as reason number 2 for not giving it to Rachit. But there is a more important reason, number 1. Completely my fault, guys. I haven't explained that. This part of the session should have come after at least 3-4 hours of input having given to you earlier. And had I done that, one of the first things I would have communicated to you, those of you who are entrepreneurs will relate with it completely. One of the first things an entrepreneur realizes in business is that there is no connection between the profit that a business makes and the bank balance that it has. And in fact, if there is a connection, one very often feels there is an inverse connection. The higher the profit you make, the lesser the money in the bank. This also I can do a whole one-day session to explain to you where the hell is the money. Because one of the biggest mysteries an entrepreneur faces is, where is the money? Accountants tell me so much turnover, so much profit. Why don't I see it in the bank? Right now, I'm trying to tell you guys, if this company makes a profit of 1,000 crores, and even if they would love to give it to Rachit, but to give it to Rachit, it's not enough that you have a profit of 1,000 crores. They will require a bank balance of 1,000 crores, which according to me is impossible. A company making a profit of 1,000, which is accompanied by a bank balance of 1,000, is impossible. But a company making a profit of 1,000, which is accompanied by a bank balance of negative 600 crore, absolutely possible. And therefore, the first and the most practical reason why this profit has not been given to Rachit is, where is the money? Assuming this company did have 1,000 crore profit and 1,000 crore bank balance, they still would not have given it to Rachit. Then your other arguments about growth, expansion, emergencies, etc., would have come in. End result would be, RF will convince Rachit, your 400 crores, had you invested anywhere else, you would have earned 5%, 10%, 20%. We can give you 30, 40, 50, but don't take the entire 1,000 crores away. And who's Rachit? He's the owner of this company. He understands, if this is in the interest of the company not to give it to me, and I am the owner of that company, then it is in my interest not to take it away. Rachit says, no problem, RF. You can't give me 1,000 crore. Doesn't matter. How much can you give me? 50%? Give me 50%. Guys, how much money did Rachit invest in this company? 400 crore. How much is 50% of 400? 200. So give him 200. How much is left now? 800. Who does this belong to? I want to see these answers in the chat box. Who does this for 800 belong to? Okay, mixed answers are coming. Guys, this 800 continues to belong to Rachit. Absolutely right, Rachit. When Rachit agreed to take home 200 crores out of the promised 1,000 crores, he has not waived his right over the remaining 800. He simply said, RF, you can't give me 1,000, doesn't matter. How much can you give me? 50%, give me 50%. Use my 800 crores. So till yesterday, how much money did this company owe Rachit? 400. Today, how much money does this company owe Rachit? The original 400 they still owe. Now they owe him another 800. So the profit that a company earns and does not distribute also appears as a liability. It appears under a heading called reserves and surplus. But RF hasn't repaid its full loan. Shrikant, I need to give you a long answer on that. When you took loan, it was not an income, it is a liability. When you return it, it's not an expense, it's a balance sheet item. Expense is only the interest component. Out of the cash flow, we'll take care of all that, but it deserves a far longer answer, which today I won't be able to give you, Shrikant. So guys, how much is Rachit's total contribution to this company now? 1200. What is this 1200 called? This is now called the shareholders. Absolutely right. Net worth. Guys, imagine this is the public limited company. They raised 400 crores by way of a public issue. No, paid up capital is 400, Mahesh. But net worth is 1200. If this company raised 400 crores via a public issue, they issued 40 crore shares, each carrying a face value of 10. And then out of every year's profit, a certain amount of profit they used to distribute, certain amount of profit they used to retain. After a few years, the retained profit has mounted to 800 crores. Today, the net worth of the shareholders of this company has become 1200 crores. Tell me, 1200 crores is the net worth of how many shares? 40 crores. So what is the value of each share? 1200 divided by 40, 30 bucks. What is 30 bucks called? This is now called book value per share. So here is a company having shares carrying a face value of 10 printed on the share. A 10 rupee face value share is enjoying a book value of 30. Now go to the stock market and find out how much is the share trading for in the stock market. There it could be for 50, it could be for 500, it could be for 5,000. That place can be a crazy place sometimes. That is called market value. Just wanted to introduce three terms to you: face value, book value, market value. But guys, I started this telling you balance sheet left-hand side tells you sources, where the money has come from. I was trying to prove that. That first item, capital, is that a source of money? Yes. Who gave it this money to RF? Rachit, the owners. Second item, reserve, is that a source of money? Answer is yes. Who gave it to the company? Again, Rachit. The first one, when he introduced capital, Rachit actually put in the money physically. In the second case, he may not have invested money, but he left behind something that he could have legitimately taken home. So item number one is Rachit's direct contribution. Item number two is Rachit's indirect contribution. That item number three, loan, is that a source of money? Yes. Who gave it to you? Some banker, some outsider, some lender. But guys, organizations not only go to banks and borrow money, you also go to vendors and suppliers and say, can you supply me goods and services and I'll pay you 30 days, 60 days, 90 days later. Those items also appear over here. Is that a source of money? Answer is yes. What's the difference between source number 3 and source number 4? In number 3, the banker gave you a loan in cash. The fourth fellow gave you a loan in kind, but it's a loan nevertheless. Do you now recognize, guys, the left-hand side of this balance sheet to be merely representing sources? How many sources there in any organization? Answer is 2. Correct. Wonderful, Mahesh. Answer is 2. Owners and outsiders. Both give you in 2 ways, direct and indirect. Everyone okay so far? But the most important question to be answered is, why is RF going around borrowing money from everybody? It is borrowing from the owners, it is borrowing from outsiders, it is borrowing directly, it is borrowing indirectly. Do you think this is an arbitrary collection of money, or must it be as per a plan? And now, since I can't see your answer, though, here your answers, many of you must be saying, Anil, it should be as per a plan. I agree with you, it should be. But it is not funny, Rachit, how often it is not as per a plan. And if this money has come without a specific plan in mind, in my opinion, this company has sown the seeds of sickness even before it has taken off. Let's for a moment imagine RF raised this money without a plan. It was a random collection of sources. It took whatever it could from Rachit. It took whatever it could from outsiders. This money has come without a plan. Now tell me what will happen. Guys, if the money has come without a specific plan in mind, now when Mr. Rachit, on behalf of RF, starts investing this money on the right-hand side, he is going to discover one out of two things happening. He will either discover that halfway through acquisition of assets, he will run short of money because money has come without a plan. Or he will discover he was able to buy all the assets that he wanted and there was money left over. Folks, I'm trying to tell you, if the money has come without a plan, you are either going to run short of money or you will have excess money. Tell me which is a happier state of affairs. Should an organization have less money than it needs, or should it have more money than it needs? Shrikant, let's examine both. Let's examine both. Imagine they have less money than they need. Rachit, when he started spending, they raised less. He wanted to start manufacturing furniture. Halfway through buying the land, building, plant, machinery, he ran out of money. Guys, how will he run the business? If you have less money than you need, you're going to get into trouble. If you have more money than you need, I think you'll get into bigger trouble. Folks, I'm now giving you a mantra. Correct, Rachit. I'm giving you mantra of good finance management, and that mantra says, please remember, less is bad, more is worse. How less is bad, everybody can readily understand. How can more be worse? Today, I won't be able to give you that answer. Again, I need 2-3 hours before of build up before I can give you that answer. But guys, remember, this rule applies across life. If you're a manufacturing company, what kind of installed capacity should you have in your factory? Less than necessary or more than necessary? How much inventory should you maintain in your warehouse? Less than necessary or more than necessary? How much manpower should you have on your rolls? Less or more? How much blood pressure should we have in our body? Less is bad, more is worse. This rule applies across life, and therefore the name of the game is optimization. So I am right now trying to tell you how much money an organization will raise is a matter of art. Because if you land up raising less money than you need, you'll get into trouble. If you raise more money than you need, you'll get into bigger trouble. Venu, I need much more time before I can answer that question. What happens when there is excess? What happens when there is short? And how do you know how much money you should raise? That answer will be given to you by the right side of your balance sheet. And therefore, in my opinion, if you're in a position to start a new business, a new enterprise, a new project, folks, the first exercise you must do is to prepare an imaginary balance sheet of the business or project that you intend to start. And tell me, which side of the imaginary balance sheet will you make first? Answer is right-hand side. Visualize till the last penny possible. If this business has to start, if this business has to see the light of day, then how much money do I need for land? How much for building? How much? And no guessing, guys. Each figure should be supported by a lot of research, a lot of quotation, inviting, designing, and so on. Rachit does that. He prepares the right-hand side of RF, projected balance sheet. And he realizes to make this business a success, the company needs 1,000 crores. Step number 2, he will look inside. How much does he have? He realizes, oh, I need 1,000 crores, but I've got merely 400. So the next realistic exercise he has to do, all right, where the difference going to come from? Who's going to be willing to give it to me? This is called capital structure planning. And once a blueprint is created that this much money I need, and this is the way I propose to fund it, now when he starts the real thing, he should start with the left-hand side. He will first invest the money that he proposes investing out of pocket. Simultaneously, he will start the process of borrowing. And once money comes in, he starts investing. Now, guys, you must help me visualize the right side of this balance sheet. What will Rachit do with this money? A sizable proportion Rachit will spend to create infrastructure. Correct. He needs land, building, plant, machinery. These items appear in your balance sheet on the right-hand side under a heading called fixed assets. Let Rachit invest substantial portion of money on the acquisition of infrastructure, but Mr. Rachit has to make sure that he does not exhaust his resources in the process of creating infrastructure alone. he better make sure, having set up the infrastructure, he still has money left. Why? He's now going to require a continuous supply of something known as working capital. So now, guys, you need to help me visualize components of working capital. Why does he need working capital? Let's imagine Rachit wanted to start the finest furniture manufacturing company in the country. He wanted to be the best. Because it was his desire to be the best, he also wanted the best quality infrastructure. So when he went to buy the infrastructure, let's imagine Rachit got a little carried away and he landed up spending more money on infrastructure than he should have. What is the situation today? Today, the situation is Rachit has the finest infrastructure in the country to make furniture, but no money left for working capital. And let's say next day, Vaibhav Chaudhary lands up over there, and Vaibhav says, Rachit, I am starting a new IT services company. And in my company, I need tables and chairs worth 100 crores alone. And Rachit, looking at your infrastructure, I think you're the best person in the country to give it to me. I'm very happy to give you an order of 100 crores. Will Rachit be able to execute the order? Answer is no. Why not? He has no working capital. So why does he need working capital? Guys, you understand, Rachit is a very lucky person. He started the factory yesterday and today Vaibhav walks in with an order. But Rachit will have to be far luckier than that for Vaibhav to say, Rachit, I've not only brought you an order of 100 crores, but it comes along with a check of 100 crores. That's not going to happen unless you're an exceptional kind of a company or something. He'll be lucky enough to get the order. Now, Rachit has to understand in this 100 crore order of Vaibhav's, the wood component alone is 60 crores. Unless he has the financial resources to invest another 60 crore in wood, can he run his business? And as a prudent business person, Rachit is not going to wait for the customer to walk in before he buy the wood. He will probably buy and maintain an inventory of wood in anticipation of orders so that the day the customer comes in, production can start forthwith. So guys, the first component of working capital is to have the financial resources. Not only to buy land, building, plant, machinery, but also to buy and maintain inventory. Second component of working capital is Vaibhav's order, 100 crore, reasonably large order. Rachit needs at least 3 months to execute it. But guys, next week is the first of the month. And Rachit's employees are waiting for salary. Landlord is waiting for rent. Overheads have to be paid. He can't tell his employees, can you wait for 3 months? The day Vaibhav pays me, I'll pay you salary. No, sir. Every business person understands expenses are continuous, incomes are sporadic. And therefore, prudence demands that you hold on to sufficient amounts of cash and bank balances so that your day-to-day expenses can continue to be met, irrespective of inflow from operations. And after 3 months of hard work, Rachit goes to Vaibhav. Vaibhav, your order is ready. Consignment is ready. Would you like to come, inspect, give me the go-ahead so I can send it to you? Vaibhav comes there, says, great job done, Rachit. Send the goods to me. And Rachit says, okay, Vaibhav, what about my check? He says, no problem. Come 60 days later and collect your check. Not only Rachit did not get advance, even on delivery, he may not get paid. And he now needs more financial muscle power to be able to last another 60 days. In the meantime, his business has to continue, guys. Third component of working capital is debtors. How much time do I left, Vaibhav?
Please continue. No issues. We have another 15 minutes, 20 minutes. It's going too
15
well.
minutes.
So
Okay.
so you
Guys,
can
I
continue.
hope this wonderful. This foundation
So,
is very necessary to take you to the next level now.
so actually,
You know,
a lot of them are from in India. So for them, it's a problem. For me, it's day. So for me, it's all right. Yeah. So
India
maybe take
also
another
it
15,
is
20
it is
minutes. And I
it
think
is
it's all right.
9:15.
Yeah.
Okay.
Yeah.
Okay. Now, folks, a few years back, the Reserve Bank of India had conducted a study. It conducted a study of, thank you guys, of all the sick businesses in the country, the businesses that had failed. And the idea was to find out why do businesses fail. Guys, just for clarification, those creditors, etc., come under a heading called current liabilities, and that loans, long-term loans nowadays have a nomenclature of non-current liabilities. if you pick up a balance sheet. Working capital is classified as current assets, and the fixed assets are nowadays called non-current assets. I hate this terminology, but this is what they've. So if you pick up a real life balance sheet, this is the heading you will find. So I was saying Reserve Bank of India conducted a study of the sick businesses to find out why do businesses fail. I'm going to do a one-sided brainstorming with you since any of you guys can't talk. So I'm going to do this. Why do businesses fail? We are all aware that India started a globalization, liberalization program with effect from 1991. Before 91, we were not that open an economy. Not that open. We were not an open economy. No foreign company could decide, let me go to India and set up shop. Impossible. Even domestic companies to start a new project or even do expansion had to go through that license Raj. Consequently, what happened was, pre-91, we had very few players. There was very little competition. We had one airline, one mutual fund, two companies making cars. Competition was scarce. And therefore, quality was also not the best in the world. 1991, government opened up its doors. Foreign companies came in. These companies probably had the latest technology at their disposal. Now I'm brainstorming with you guys. You tell me yes or no. Do you think it is possible that in the post-91 era, some domestic players must have found now competition has come from overseas? Those guys are way ahead of us in terms of technology. Compared to them, our technology is out of date and we don't have the money to buy new technology. Some companies must have become technologically obsolete. Do you think technological obsolescence could have been responsible for a certain portion of sickness in industry? Right? Yes or no in the chat box, guys? Yes? Okay. There could be a second category of entrepreneurs. Wonderful. Who technology-wise were as good as anybody else. The problem was not the ability to make. Their weakness was they knew how to make, but they didn't know how to sell. Do you think marketing inefficiency can lead to sickness? Possible? Yes or no? Okay. There could be a third category of entrepreneurs who knew how to make and who knew how to sell. But their misfortune was they had a very militant and unreasonable trade union, which went on extended periods of strike when for months production came to a halt. Guys, do you think labor problem can lead to sickness? Yes? No? Folks, Reserve Bank of India conducted a study of all the sick businesses in the country. And their study has found out of all the sick businesses, over 95% were not sick due to any of the three reasons. That means the three reasons and some more put together were responsible for not even 5% of business failures. And over 95% businesses had failed due to one reason, and that is financial mismanagement. And I've given you Indian statistics, but my statistics applies all over the world. It is an undisputed fact that in the world, if 10 companies shut down, more than 9 shut down on account of bad finance management. And recent history has told us not only companies have shut down, entire countries and economies have shut down due to bad finance management. Entire subprime crisis of the United States can be attributed solely to bad finance management. There are countries in Europe right now as we speak, Germany, Spain, Greece, Italy, the countries in South America, Venezuela, down south from India, Sri Lanka, Nepal, Bangladesh. They're all suffering the consequences of bad finance management. But what does it mean? What does it mean when I tell you 90 to 95% businesses fail due to bad finance management? I will tell you what it means to me. If somebody came to me, an entrepreneur came to me and said, Anil, my business shut down. Why? I became technologically obsolete. I don't understand how to blame him. Suddenly, this poor guy finds in front of him a giant has come up as a competitor. This giant is miles ahead in technology. Compared to him, this poor guy's technology is out of date and he doesn't have money to buy the new technology. How can you blame him? Or another entrepreneur comes and says, my business failed because of labor trouble. Guys, sympathies go out to him. How do you blame him? But when anybody says my business failed because of financial mismanagement, I think the entire blame lies on his shoulders. Why did he go sick? Remember this question of mine to you? How many of you are non-finance people? And most of you said yes. Real finance people in the company call themselves non-finance. And this flawed perception, whose responsibility it is causes 90 to 95% business failures in the world. I'm saying if more people did what you are doing right now, you're all busy guys, but you're taking time out. You're sitting through, doesn't matter, too small a session, but hopefully if it sparks off a desire and you take steps to learn more. I'm saying if more people did that, that 90 to 95% that failed on account of bad finance management need not have failed. This is an avoidable reason of sickness. It's a pity. So when I go on and on like this, how important is finance management? What a price we pay for bad finance management. And therefore, everybody should practice good finance management. And when will good finance management happen in your company? Not only when your finance department is the best, guys. When everybody in your company understands it's my responsibility. When I go on and on like this, chances are one of you gets up. Pardon my speed once again, guys. It is intentional to do something before I am asked to stop. I'm already overshot my time. When I go on and on like this, one of you say, Anil, I'm convinced good finance management very important in my organization. It can only happen if my finance management is good. Then what will be your next logical question to me? Your next logical question will be, Anil, can you tell us what is good finance management so that we can start practicing from tomorrow? Now, when somebody like you would ask me this question, my reaction would be, I'm sorry, good finance management is not a two-line definition. It's a whole subject. It's a whole philosophy. It takes years to learn. And then I used to feel the unfairness of it all. What am I doing? I am first communicating to you how important the subject is. I am perhaps creating in you a desire that I'm willing to take the efforts to learn. And when you say I'm willing and I'm ready, I say, I'm sorry, I have no answers for you. I used to wonder, can I give you a magic formula? Guys, you want to practice good finance management from tomorrow? Here is a magic formula. Do this from tomorrow. Good finance management will happen. Now, obviously, there are no magic formulae. But what I have is something pretty close to that. I will now give you what, in my opinion, is good finance management presented to you in the form of two rules. Let's call them the two golden rules of good finance management. Guys, my complete conviction is you understand these two rules. They're very easy to understand. According to me, the whole subject of finance is common sense. This is not rocket science at all. These two rules are also common sense. You understand these two rules. You internalize these two rules. If you promise me never to violate these two rules, I will promise you most problems that others suffer from on account of bad finance management, you will not. I repeat, if you promise me never to violate these two rules, I am promising you a majority of problems that affect others. And please understand, a majority of problems that affect others are financial mismanagement related. You will not suffer from them. Today, obviously, I won't be able to cover. But I'll give you both the rules in a nutshell. But keep in mind, each rule deserves about hour and a half, 2 hours of elaboration. That obviously we can't do. But Vaibhav, with your permission, I'll quickly, as brief as possible, tell them what these two.
We can even go another 15-20 minutes. It's not a problem. Yeah.
I'll
The
just
operations team is supporting us. Yeah. It's totally up to you.
Okay.
Yeah. Totally up to you.
Okay.
Yeah.
Okay. Guys, this is a familiar statement to all of you now. What you see on the screen, what is this? Balance sheet. What does the left-hand side tell you? Left-hand side, when I say left, right, I mean this balance sheet. In America, they present it other way around. Assets on the left, liabilities on the right, and so on. So in this case, what does the left-hand side tell you correctly, Rachit? Liabilities. Right-hand side tells you, no, we won't call it liabilities. The left-hand side tells you where the money came from. Right-hand side tells you where the money has gone. Nilesh, where does money come from? Two sources, owners, outsiders. Where does money go? Two avenues. Infrastructure, working capital. How many components of working capital are there? Three. Inventory, cash, debtors. Everyone okay? Now, what are these two rules? Listen carefully, guys, everybody. The first rule says, if the left-hand side tells you sources, where the money has come from, and the right-hand side tells you what you did with the money, then guys, always remember, never forget that out of all the sources appearing on the left-hand side, none are free. Money is not free. Sources come at a cost. You may say, okay, so what? What did we do with this money? We've gone and deployed it on the right-hand side. What have we acquired out of this money? We have acquired for ourselves some fantastic assets. And what kind of assets are those? Hopefully, what you have acquired are productive assets. So, guys, if the sources of money appearing on the left-hand side of this balance sheet have a cost attached to them, then the utilization of money appearing on the right-hand side have an ability to earn associated with them. And the first fundamental common sense rule of good finance management says you should never invest your money in any activity, any project, any business without ensuring that what you can earn from the right-hand side is at least equal to, preferably greater than, the corresponding cost of the left-hand side. Absolutely common sense, guys. What does the rule say? Rule says recognize left side of the balance sheet has a cost. Right side of the balance sheet possesses an ability to earn. When should you invest your money in any activity? Only after ensuring what you are earning from the right-hand side is, Samir, correct? Is either equal to or greater than the cost of the left-hand side. Rachit, you are saying greater than, I'm saying equal to bhi chalega. And there's a reason why I keep repeating equal to, right? Guys, on the one hand, this is such an elementary rule. To understand this rule, you do not even need to be literate. I think even illiterates understand this. What do I mean by that? Imagine you catch an illiterate fellow. Tell him, there's a money lender sitting over there. Tell this illiterate guy, will you go to that money lender and borrow 10,000 rupees? This illiterate man goes to the money lender, borrows 10,000, but the money lender says, I'm going to charge you 15% interest. The moment this illiterate fellow walks out of the money lender's shop, you intercept him. Tell him, now give this 10,000 to me and I will give you 10%. What answer will you get? No. Why not? This illiterate man is not going to use this language. But Amol, Kunal, sorry, this is too bright, I can't see something. But the illiterate man is effectively saying, I can't give it to you because what you offered me just now has violated the golden rule number 1. What was golden rule number 1? First, understand what money costs you. And then when you deploy it, do not do so unless you can earn a return that is equal to or greater than the cost of capital. Guys, on the one hand, I told you this is the golden rule. On the other hand, I'm telling you, even illiterates understand this. Your reaction will be, Anil, if everybody already understands, why are you calling it a golden rule? Ladies and gentlemen, I assume there's some ladies also. Ladies and gentlemen, you will be amazed. You will be amazed what an illiterate person will not do. How many large corporations there are that are guilty of doing. Today, I don't have time to give you the names and all, but I've been talking about this for too many years. But recently, I was reading an article by Bain and Company. And Bain and Company research has found that in the US, 9 out of 10 businesses routinely fail to earn even the cost of capital invested in them. In other words, where this illiterate guy said no, in America, 9 out of 10 companies would have said yes. And if that's the case in America, India probably, I don't want to say, imagine what must be in India. India is far smarter, but Indian numbers could also be in the similar range. How it happens, unfortunately, some other day I'll tell you. So guys, you went to this illiterate fellow. You said, give me that 10,000. I will give you 10%. What answer did you get? No. Why not? He said, I'm paying 15. How can I give it to you at 10? Let's say you tell him, okay, you're paying 15. I understand. I will give you 20%. Can this illiterate guy give this money to you now? Is this opportunity satisfying rule 1? Yes. But he may still not give it to you. Now, why won't he give it to you? He may not give it to you if this investment opportunity, which is satisfying rule number 1, is perhaps not satisfying rule number 2, which I haven't told you yet. In fact, rule number 2, I want you guys to draft it yourselves. I'm going to give you the situation, you tell me the rule. When this illiterate person went to the money lender, I want to borrow 10,000. Money lender said, all right, but I will charge you 15% interest. And the money lender said, Mr. Borrower, there is one more condition. Make sure you return this money over the next 1 month. You went to him, you said, give it to me, I'll give you 20%. And I will return the money after 2 months. Now, here's an investment opportunity that is satisfying rule number 1, but fails to satisfy rule number 2, and therefore still should not be taken up. Can you help me, Nilesh, little more elaboration? Can you help me put rule 2 into words? To save time, I'll only give you the answers. I won't wait for your answers to come in. Rule 2 says, also don't forget. First, what did I tell you not to forget? Money is not free. Rule 2 says, also don't forget, guys, none of these sources on the left-hand side are gifts. Under what heading do we show them? We show them under a heading called liabilities. What does it mean? It means every person who has given you the money today will be the same person standing outside your door sometime or the other saying, I want the money back. But you took this money and deployed it here. But the guys on the left are going to come asking for it back. How are you going to give it back? And therefore, rule number 2 says, invest your money in such a way that the assets will bring it back before the liabilities come asking for it back. Rule number 1 says, I'll give you a graphical presentation. You guys are all engineers, so graphics make more sense to you all. Rule number 1 says, guys, remember, sources have a cost. So when you deploy, it better be earning. It should not only be earning, preferably it should be earning greater than the cost. Rule 2 says the sources are liabilities, not gifts. So they'll have to be paid back. So you invest it in such a way that the asset will bring it back, and it should preferably bring it back before the liabilities come asking for it back. Rule number 1 says in words that investment in assets must generate a return. This you can take a screenshot if you want, which is at least equal to the cost of capital. And rule number 2 says assets must bring a cash inflow before the liabilities demand an outflow. These are not standard rule, guys. These are my rules. But bring me any sick company's balance sheet, and I will show you which of these 2 rules was violated. Or if these rules were not violated, that company would not be sick. Before I forget, I just want to quickly tell you one thing. If you are interested, every Sunday I send out a little text, Sunday musings on finance management. In case you are interested in receiving it, I'll show you this. You can join the group and you'll start receiving that little thought-provoking thing every week from me. Anyone interested, do so. Now we are open to questions.
All right. Thanks a lot, Anilji, for your time and this workshop. I won't call it a talk. I would call it a workshop rather. Hopefully, we can have even a larger one, actual workshop, because we do it
Apologies for
as
the
well.
speed, but apologies for the
No,
speed.
but it's perfect. It has been perfect. So there are a couple of questions. So let me start with one of the questions. So because you have
Sure.
a couple of books, so Nilesh has asked that which of your books are a good starting point to learn
I think the
financial
center
management.
one is the good one to start, that romancing the balance sheet. Your video has gone off, Weber. Are you there?
I am
The
there.
screen
Probably,
is
yeah.
screen is
Probably,
disabled, is it? Okay. Cool,
probably
cool, cool.
Jijo is making
So
some
I'll,
changes.
I'll put up the screen. Yeah.
Yeah, no issues. Yeah,
So
no issues.
romancing
No
the
issues.
balance sheet is a good one to start with.
Okay. All right. And Venu, you want to take the next question?
Sure. So I
Yeah.
think it was a very, very helpful session, Dr. Lamba. I think just the enthusiasm at the start of how many people are, non-finance, I think is completely reversed with the chat. Now I think everybody has participated, and now everyone's qualified to call themselves a finance person. So I
Correct.
think that's a very interesting point to note. Now, one of the questions that has come by Mahesh is how to start and learn finance and financial management from scratch. Best way,
You have to come to me,
resources,
you have no
and
option.
advice.
One of my Sunday musings was it takes guts to start a business and financial acumen to sustain it. If you have the former, I can supply the latter.
Yeah.
Right, right. Mahesh, I think that probably will help you. And I think
I'm joking, guys. I'm
Dr.
not
Lamba
selling
also
this.
conducts, you
Take it in
conduct
a
sessions
life
also,
style.
right?
Yeah.
Yeah, that's a hobby turned
Perhaps,
full-time activity.
Mhm.
perhaps what we can do is along with this QR, we can circulate that in the group. You can share it with Webhub.
Yeah, I can see
Yeah,
We
Shivam
I'll
will
do
saying
that.
circulate.
barcode failed, so I'll probably send it to you. You can share it with them later.
Yeah,
Yeah.
I'll do it.
Yeah.
I'll do it. It's not a problem. I have already joined the group, by the way, so I'm there. I can see what's
Oh,
happening.
yeah, yeah. Okay.
Yeah. And I see another question is from Ramesh ji. He has asked, is there a balance sheet prepared for a nation on annual basis?
Is there a?
Balance sheet prepared for a nation on annual basis?
Yeah, yeah, of course.
Because I
That's
guess
my
you are
favorite
mentioning
topic
about
when I
countries.
talk about macroeconomics. In a
Uh-huh.
way, if you read the budget, it's a profit loss and balance sheet rolled in one. Thank you, Rachit. I read your message. Thanks a lot.
Uh-huh.
Budget is the P&L and balance sheet rolled in one.
Uh-huh.
It's futuristic, but if you take last year's budget, it gives you the P&L and balance sheet. And all
All
of
right.
us should read it because we are all shareholders of India Inc.
Interesting. Yeah. Do you see any other questions, Venu? I don't
I
think so.
I don't think so. Yeah.
Yeah, all right.
But
All right. I think, yeah, because already we have exceeded the time, not much, but just 10, 15 minutes. But that's all right. So, Venu, would you like to say the final words, maybe?
sure, sure, Vaibhav. So I think just to sort of call it out, this has been a very educative session. It's more of a workshop than talk that we normally do. So I think that is something that we all have enjoyed, and I think having people come in with this kind of experience. 3,000 large or medium-sized corporations that you've had the experience with. I think we rarely see such credentials, so that is definitely an opportunity for all of us. So first off, I think the session was fantastic. It was educational. As a speaker, we're fortunate to have had your session today. And third thing I think to note is in the entire session, nowhere I felt that I'm sitting in a class and doing finance or listening to finance, because it felt very easy to digest. And that is a key difference that I would note between, say, my formal or the classes that we attend versus, say, something like this. So I'm sure even 3 days or 5 days would have been fantastic without a burden on the brain. But thank you very much for the session, Dr. Anil.
Thank
All
you, guys.
right.
It's a
So,
pleasure. Thank you.
yeah, no, no. Thanks a lot, Anilji, for your time and final words from me as well. It's exactly like workshop. So actually, we do workshops as well. And meanwhile, you were talking. I was discussing with Jijo, who's taking care of the operations team. Maybe invite you for that as well. And because the audience itself, they were posting, they're quite interested. So hopefully, I will be looking forward to other synergies in the near future. And obviously, we'll remain in touch. Thanks a lot for your time once again. Yeah, yeah.
Thank you.
Bye bye. Yeah, bye everyone.